Fed is still a little bit aggressive in their ideas about where growth is going to be. They're at roughly at 3.5%. I think the street average is about 2.5%. So the Fed needs to come down there. Bullard came out today and he said he didn't believe that there would be hikes. He was thinking one maybe in the next few years. Nonetheless, not necessarily even this year. I think December is still in play. So until that is proven otherwise, I'm going to still think so. We'll see where the Fed numbers are, the future Fed funds future numbers are when we get closer to the date. There's a few things that the market is really keying off of here. I'd asked during the week what people thought was the most critical aspect for the market, and overwhelmingly people answered oil. I don't have that study in front of me, but I'll tell you this: the order that I see things in is that oil is very important to kind of the, and I think this will really show you the way people are thinking. I had also posted a tweet that said, if you're running your entire account based on 5 and 15-minute bars, you're doing it wrong. You'll probably wind up bankrupting your account. The algorithms, the trading algorithms, are still correlated to oil. I told you guys a few weeks ago, and I know a lot of people were saying, and I kept on getting this question: has the correlation between oil and the market, ES, is it gone? And I said that no, it wasn't gone, that I thought it was just weakened a little bit. But it's now obviously back in full force. The way I see the market keys, and I've discussed this before, the most important one isn't oil. It's actually the bonds, the TLT, or ZB, if you want to use the futures, because that is the driving force behind the rally. That's really the Fed. And those interest rates, and I've talked about this, are what's key to the valuation. They're sort of the used into the discount factor. And as long as interest rates stay this low, it forces people into risk assets. So on a 5 or 15-minute chart, oil is the most important, but in the bigger picture, the bonds are the most important, followed probably by the dollar, because oil, first of all, is priced in dollars, and corporations who do business overseas are involved with currencies. So the amount of business that relies on oil is relatively small, but it shows you where people's heads are. I think people are still too narrowly focused on 5 and 15-minute bars, and that'll be death to people on days like today or this entire week because it was so choppy up and down. My advice to people, and this is really going to be quite simple, and I hope this really can help people do better in their accounts, is think about what you're good at. Think about a game you can win. Are you going to be able to beat a multi-million-dollar algorithm that can trade S&P and has access to all of the factors on 5 and 15-minute bars? Can you act that fast? Can you get in and out that quickly? Often it's possible to make money on trending days or on quick trades on violations of 15-minute ranges, but in markets like these where it's very narrow or choppy, you're not going to have an edge. And I think a lot of people are trying to compete in an arena that they can't win. Think about, my favorite example is the I think it was, I don't know if it was, I don't think it was Chinese Connection. I forget which Bruce Lee it was. But Bruce is fighting Chuck Norris, and he's fighting him in the Coliseum. And it starts out, where they're both fighting in their own styles, and halfway through, Chuck is getting his teeth kicked in, and he tries to switch to Bruce Lee's style, and then that's just it. He just gets completely creamed. Think about a game you can win and play it. If you don't know the rules, if you don't know the, what's going on, you're not going to be able to know all the factors at any given time. You're not going to be able to win. So just keep that in mind. You might want to think in different time frames. I usually try to think in different time frames. I think about what's going on immediately right in front of me. I think about what's happening interim and then bigger picture, longer term. So as they say, the trend is your friend. I also want to go back to my rules for a moment. Someone's asked me if the market will tank if there's a rate hike in December. I've had that question a few times. My answer to that question is it depends where the market is. If the market comes into the Fed at all-time highs and they raise rates, there'll probably be some type of a knee-jerk correction. But if it's been going down for weeks and weeks or days and days ahead of the Fed, it might be a relief rally. So it really depends on where things are. You can't ever just answer that question within a vacuum. It's sort of an if this, then that. Also, people were saying, what are going to be the reaction to interest rates? I mean, you'd think on a Fed hike, interest rates would go higher. Again, depends on where they are at the time. If the Fed moves more or less than expected, I mean, there's a lot of factors that go into it. I want to just go through a couple of my quick rule. I have this video I do. It's the 10 Risk Management Commandments, and there are a few that I think would be very applicable to this week, and I'm going to review them quickly now. The first one is you shouldn't be involved in every move in every stock. You can win a horse race, but you can't beat horse racing. That's actually a quote that I lifted from Jesse Livermore from Reminiscences of a Stock Operator. So that basically means, you can't play everything. I tend to focus on a very narrow set of stocks, and I play within a field where I know I can have at least an edge, or I feel like I can win. I call them the fire engine chasers. Whatever's up big or whatever's down that big, everyone always has to be involved. They get attracted to where the action is, the flashy lights. I can tell you from experience, you'll wind up losing a lot of money if you try doing that. Something's down big, so you have to be involved in it. It's the bottom. Oh no, I assure you, you'll lose plenty of money that way. Or something's up huge, so it's going to go up even more huge. Stick to what you know, and never leave your wingman. That's the great the great quote, right, from Top Gun. Never leave your wingman. The price is always truth. There are a lot of people I notice that I'm going to kind of jumble these up a little bit as I feel them applicable. I wrote the rules so I can change or break the rules, or co-mingle the rules. Anyway. The price is truth, and you'll find I find a lot of people also like to add to positions, but they're not necessarily always adding to winners, they're adding to losers. And one of the things that I find incredible is that as the market is rallying higher, people who have been short for a long time and have been wrong, I mean, they're underwater, right? The stock market is at an all-time high. They keep adding and adding to shorts, and they're like high-fiving all over Twitter like they're adding to winners. That is incredible to me. The same thing if you're in a stock and it goes down big, it doesn't mean you have to add to it. Like if I buy a stock and the next day it goes down on me, I'm not looking to add. That's not what I'm thinking. My first thought is, my God, this thing is going against me. I want to have a stop loss, or I want to minimize, do I have to hedge? Do I have to put in an options position? Just because a position doesn't go my way initially doesn't mean my trade is wrong. I like to give things a little bit of room to play out. That's also an important part of being a trader, but that all happens with setting your stops and your risk management setting it up ahead in the first place. So, like, for example, a couple of days ago, I think it was like 2 Fridays ago, I was talking about Apple long. I liked how it closed that Friday. It rallied up, and then the next day it was down, and it looked kind of weak, like a bit of a reversal. I saw a lot of guys on Twitter, they were like, oh, we're getting out of it, or whatever. I stuck with it because my initial play was that it needed to hold the 200-day moving average. So if you got stopped out that day, you probably either got stopped out at break even or at a small loss, as opposed to being up $4 or $5 now. I mean, it's 3 to 5, let's say 3 and change or 4 and change. That is setting your standards for the trade. That's very important to give something enough room. The other part of that, though, and this is important, is you got to come into a position starting right. Think of it as like building a building. You want to have a solid foundation so you can build a huge high-rise and do it on stable ground. A lot of people don't start out right. They don't buy at the fib or the trend line. They kind of jump the gun because they want action. Everyone is sitting in front of the computer all day. They're action starved. You got to be more of a sniper. You got to wait for your shot. In the military, snipers often wait days, sometimes even maybe weeks for their shot to set up. And I guess that's hard to watch, while the action go by and you see, this stock is up and that stock is up and blah, blah, blah. Stick to what stay on target. But make sure you're you're looking for the right target. That always, comes with experience and analysis. I find starting with the right size, not too big, not too small. It depends on the situation. If you have an uptrending market, you have the sector going up, the stock is going up, you might want to go in bigger size. If some things are not going your way, like you have a iffy, choppy market, or the sector is not so great, but the stock is doing well, adjust size accordingly. Get in correctly, buy right, short right, sit tight, get in properly. But have your trade planned ahead of time. Don't necessarily just jump into whatever guy on TV is talking about and assume that that's the right trade. Plan and set this up properly ahead of time. I always talk about taking profits along the way. A lot of people are very all or nothing. They have to either be 100% in a trade or 100% out. If I hit way markers, so to speak, I like to say interim targets. Like, if a stock is, let's say, let's just say I'm just going to use whatever, XYZ stock. I buy it at $50, and there's a gap fill at 75. It gets to 75. I'm going to take some money off the table. I don't know necessarily that I'll book the whole thing, although I probably would. But let's say I thought it was going to still go higher. Like they have, have a big profit in it, and I think that it can squeeze further. Like earnings are in a week, it's already filled the gap, and I think that they're going to squeeze it further into earnings. I'll take a quarter off, I'll take half off, whatever. Always take profits along the way. This week, during the week, there were two stocks that I had talked about booking profits in, and that was AMBAC, AMBC, and also Shake Shack. They both had run into the numbers. AMBAC was actually just a bit of a, I wouldn't say pure luck that I wound up selling it basically at the high, but I look for certain characteristics going into earnings. AMBAC had been up a lot. I'm still, by the way, bullish on the stock. I just wanted to pull back a little bit more, and the risk reward to me going into earnings at the dead high after having run $8 off of an 11 and change basis, and me having caught like more than half of that, I wanted to, I had like $3 or so in change in the bag in that. Percentage-wise, that's really big. I mean, think about it. That would be like buying a stock at like 160 and pumping out at 190. Not bad, right? So that was my theory on that. I just had thought it ran a lot. It started that last day was a big kind of capitulatory. That's what I'm always looking for, by the way, like into earnings. If often I don't play the actual earnings. I play like the squeeze into the earnings or the lead up or the sell off before. There are a few exceptions with the shake and bake scenarios that I talk about quite frequently on the stream, meaning a stock is up, then it has multiple days of sell-off to kind of shake out the weak hands, and then it kind of goes. That's like classic textbook for Apple. By the way, it played out perfectly for Apple this earnings season, which I had discussed. But AMBAC had run. I wanted to just lock in some of those gains, and I did. The important level here, by the way, that it needs to hold is 1778 short term. It seems to be holding there. I would really like to see a bit of a deeper correction, just back to like the 16s or whatever, but we can't always get what we want. That's the important level there. The aforementioned Shake Shack. So why did I get out of Shack? That got a gap fill. It got my price target. I tweeted in real time. 42.23, was the spot. It actually got even higher. It got to 42.94. I'll tell you this, I had been short puts. How I had been playing Shack at this point was I was short puts. And I remember at the time I got the alert on the price, and I thought I could get I could buy those puts back a little bit better. But I fell back on a rule that I have put in place that has saved me, I can't even tell you, countless thousands at this point. It cost me plenty to learn to do this. So I want that tuition fee to go to work for me. I don't need to pay a second tuition fee. I don't need a master's degree in that. So I'll tell you this. It got my gap fill, it got my price target. I find with options, if you get the move you want, you take them off. You don't get stupid and greedy. Playing for that last 30 cents or, after you've made a couple of bucks or whatever, it always is an amateur move to try to get the 100%, particularly with multiple days. Like if it was like a Friday expiration, I might have played the ball. But this was like weeks out, and I said to myself, let me just close. I said, Self, let's just close them. I closed them at 30 cents. I think I probably could have closed them for like 20 or 25 cents. That would have been one of the most costly plays to play for the last 5 or 10 cents would have cost me dollars in that trade. Wound up being correct. When you get your price target, book some profits. I'm just telling you, you will do much better in terms of your P&L if you're smart like that. Shake Shack now, by the way, has pulled back to roughly where I've been wanting to buy the pullback, somewhere between 37s and 36s, and now for 2 days straight it has held the 50-day moving average, and today had a bit of a higher low. It didn't quite close above the 200, which would have been nice, and it's also below 38.64, which is from a while back, that was an old all-time low, which became a little bit of resistance. I'll tell you this, on Monday, if you can get Shake Shack above Friday's high, I think it's a long. If it goes back below the low, it's probably a little bit iffy. Today I sold small, a few puts just to kind of get my toes wet back into the position, just because I've worked this stock really well. I've done really well buying this stock in the low 30s and pumping it out in the low 40s. This trade has worked for me many times, and you'll find when you're a trader, you do what works until it doesn't. And I am for sure doing that with that stock. Back to our little list here, and we're going to work in some more stuff. I talked about taking profits along the way, never adding to losers. That's always that's really a terrible way to trade. I know a lot of people proponents of that. I just don't. I don't really. It's not how I think. I've given the example before with the store where you have two shirts that you're selling. You have one that's selling out really well, and you have one that's just sitting on the shelves and no one's buying it. So when the one that's all sold out, when your distributor calls you, do you order more of the one that's sitting on the shelf that no one's buying, or do you buy the one that's hot that you can't keep on your shelves? Obviously, we know we're going to buy the one that's hot on the shelves. So why would you be adding to a losing position? If anything, with these shirts, they're not selling at full price. What are you going to do? You're going to discount them in order to get them out. That's sort of like what the stock market is, supply and demand. There's no demand for it at $100 or $50 or whatever. I shop fancy, right? $100 shirt, let's say $50. You'll sell it for $30, and then you'll be able to blow it out. The one that's selling at, that's selling out, you could probably either try to raise the price, although these days with Amazon you can't, but you'll at the very least be able to keep it at the same price. For the purposes of the stock market, though, that price would be going higher. There's a scarcity value. So that's really the right way to think of the market. It's always supply and demand. Again, going back to the earnings position, is inventory long or short? Have people already loaded up into it? That's why Facebook, by the way, had a hard time holding its gains. They put up phenomenal numbers. I don't care what anyone says, those numbers were frickin' great. The problem is that everyone and their mother owned weekly calls, and again, I keep trying to tell people, don't buy the weekly premium, sell the weekly premium. People were long, they came into it. They're lucky the number was good, because if it was bad, the stock would have gone down, I think, pretty big. It wound up being a good number. I had the inclination that we were getting close to that 61.8 extension. I talked about booking a little bit of profits ahead of time and then taking it. Even after hours, I had said use the 131 as a stop on the long. If you took my advice on that or whatever, you followed my levels, you made out pretty well. Again, this was all positioning. The inventory was already long. So people already were loaded up hoping for an even bigger sucker to take them out higher. Nah. That's, by the way, why the shake and bake works. All of the weak, late people who have been chasing are out. They've sold for the last few days when something comes out. And they're all blown out. And if anything, you've sucked in some new shorts. That's why the shake and bake is so powerful. Rallying into the number, to me, is very risky. It often pays off with a still higher pop, but that pop usually doesn't last. And in the case of Facebook, a lot of those gains didn't even last into regular trading hours. So if you had options on, you weren't even there to benefit from it. Always kind of think about the supply and demand for the stock. In the end, that's always what it's about. Oh, this is really key. I was talking about this with a few people, actually. I'll tell you, a lot of people send me direct messages, and I try to answer them as best as I can, and I always tell people, and I'll tell you, I know this again from experience in my youth, never be at max margin. If you're at max margin, you are not able to take advantage of opportunities. When things sell off or things rally, you're always in a position, and often those positions will go against you. When I was younger, always thought about I only have to grow my account, and if I'm not at 100% margin, I'm missing out on a ton of opportunity. I'm watching the market go higher, and I'm not getting that levered move up. I assure you, when things go badly, and I believe there's something like, I think I once calculated this, that there's always like a 1/3 chance that you could always blow up your entire account, believe it or not, if you're trading like that. I'd often spend months making back losses because I was just overextended in stocks, and something would go against me inevitably, and I'd be too big, and price didn't always matter to me. Like, I had puts that expired, and no matter how far the damn thing ran, I'd always re-up. I don't think like that anymore. Let me tell you, I think the exact oppositely. If things are going really splendidly for me, and I'll tell you, beta weight your portfolios. If you're big into tech names, do it to the Qs. If I am up multiple days with my account and I'm way outperforming what I should be making for every point move in the Qs, I know that it's getting late, long in the tooth, late in the run, and I'm not looking to lever like I might have been because things are going great. That's a total amateur move. I'm looking to unload and book some of my profits while I have them. Always book profits when you can, not when you necessarily have to. Trying to catch the last couple of ticks in a move will be very, very costly. I remember a couple of summers ago, I think it was Tesla. This was like one of my epic calls, right? One of the ones that I guess made me famous, as they say. I had made the call to sell Tesla, and I think it went up like another $1 or $2 maybe afterward, and someone had tweeted me, "Oh, you missed a point or two." The stock was shortly after that down like well over $100. So do I care about missing the last 2 or 3 points, or do I care about the $100 that the stock went down afterward? I don't know, you tell me. So for me, it's always, I find missing that last couple of inches. Often I catch those inches, although I tend to be a little bit conservative. I sometimes do miss them, and it's frustrating. It's very hard to sell something and then watch it keep kiting up higher after you. I've definitely had examples where it doesn't pull back right away, where it just does keep going. But I had my plan, I traded my plan, and I'll tell you, the answer, and I think the problem most people have is they have what's known as recency bias. They think about the last time that happened, or they tend to only think about the time where it went badly for them. For every time I have sold and taken profits and the stock went a smidge higher and then completely caved, there were probably 10 of those for every one where it just kept on going. That, I'll tell you, over 100 trials, if you threw 100 coins in the air, for example, often they'll roughly land, and let's say you did that 100 times, over multiple iterations, you'll roughly have, assuming fair and balanced coins, and I'm going to talk a little statistics with you because this is very important, and believe me, I've taken very, very extensive statistics classes. Roughly 50% of the time, they'll land on heads and roughly land on tails. Once in a while, and this is why casinos, by the way, can always beat you. One, because I think they cheat, a lot of them, just so you know. I've definitely had runs with dice where I think that things are a little shady. But they have table limits, think margin, and if you can get a run roughly when you throw those coins where 15 in a row are all heads or all tails. It's very hard to go under those guises. The betting discipline, like in blackjack, for example, if you want to be a successful bettor, and I hope I'm not getting way off topic here, but this is really applicable to the market. Let's say you bet $50 and you lose. Your next bet should be anyone? 50 bucks. You lose 50 bucks, so now you're down 100. Your next bet should be 100. Again, over time, you'll be able to either break even and then start extending runs. You're counting on being able to stay even until you get that run of 15, and then you kind of leave. I've done this. It's worked very successfully. I'll just tell you that that's the proper betting discipline. But you don't want to, in general, you want to have a proper strategy. You want to know the game you're playing. You want to know the rules. You want to know where the edges are. Anyway, that's that. I don't want to get too much more off topic there. With regard to the max margin, though, if you are at max margin, you can't keep doing that where you double up or whatever. You're going to blow out your account. That's the whole point. Yeah, I give the example, capital is your fuel and margin are the bullets, and if you run out of either, you're dead meat. I took that quote from Lou Gossett Jr. in Iron Eagle when he tells Doug to watch his fuel and his bullets, and if he runs out of any, he's dead meat. So I made the equivalent to fuel and capital is your fuel and your margin, really. One thing that I find really key, if you have discipline, I have position discipline, where, like, for example, if something breaks trend, I'm out. But let's say you get a big move overall in the market, a wave type of move. If I ever am down more than maybe 10 or at max 15% of my entire account value, you know what I do? I close it all, and I just start from scratch, because I'm either beleaguered managing losing positions where I can't focus on opportunities, or I'm just positioned improperly and I need to completely get out. That happens very, very rarely. It has only happened, I would think, in the my recent history, maybe once or twice in the last 5 years. So that is a rule. That's the keep the lights on rule, because once you start getting down more than 10 or 15% of your capital, you start having to be making up huge percentages just to get back to even. Don't move your stops. Don't adjust your discipline. If something goes down to your stop, don't say, "Oh, I'm going to think about it a little." I mean, I don't mind if you give it a couple of cents. If it's a slight violation. And then maybe it closes better intraday. If your plan was always, a close below the 50 MA or whatever, and it's just lingering a little bit there, and it closes maybe a smidge below, and the next day, you want to give it, maybe a few minutes. That's all right. I mean, I don't mind, but I'll tell you, that's taken years of experience. Often, I won't give it that extra inch. I'll say, you know what? It got below there. I didn't like how it traded. I think the market looks crappy. I don't like this or that. And I'll be out of it. And I'll tell you, I've had experiences where I've waited and I've paid the price for it. And I'll tell you, I don't wait. I try to take those losses as quickly as possible. The same thing with the move up. Today, for example, a buddy of mine was trading in this Haynes Celestial, and I saw this thing move. And it just spiked up ginormously, but I don't know if he realized 56.31 was the 61.8 of the entire move. And it shot a little bit above there, and then it wound up backing off I think almost $2 initially. So always be prepared. Have your levels. Know your levels. Have that planned out ahead of time. Don't just wing it. Oh yeah, this is also really important. I say this, and this is very hard to do in practicality, but it will save you a fortune. Be dispassionate about your play. Don't put on so much that you're going to be up all at night. Try to think clearly. Be in a size where it doesn't matter if it goes up or it goes down, if it goes against you. You want to try to think like a bit of a machine. You don't want your emotions to play on you, play on your fears. This is how we're built. Human beings are built to be hopeful or fearful, optimistic, so on and so forth. Try to not do that. When you're hopeful, I'll tell you this, it's almost to do the opposite. If a stock is going up, it's going in your direction and you're long, be hopeful for still higher prices. That's fine. If a stock is going down and you're long, don't be hopeful that it will rebound. Be fearful that it will go down still further. Usually people have the exact opposite. They buy a stock, it goes higher. They're fearful of losing that fearful of losing that gain. This is how people think. I assure you, I find myself thinking this way very often. It goes up a little bit, goes a little more. All right, I'm up, whatever, 2 points. I must lock that gain in. I'm afraid to lose it, only to watch the stock go up another $10. Don't be so quick to book profits when you're right. If you buy right, sit tight. That is very important, and that's really where the big money is made. I assure you you'll find that if you can really master that discipline, you'll do much, much better. Keep in mind the type of market you're in is very important for that. If you're in a very choppy market, you want to maybe swing and look to hit singles and doubles. Like the market we're in right now, you want to be swinging and hitting singles and doubles. But if you're in markets where things are really moving and you get a good trade location, either long or short, don't be so quick to take profits. Let them run a little bit. Be quick to take the loss, but don't be so quick to book the profit. Be hopeful when things are going in your direction and fearful when they're going against you, not the opposite. That is a huge piece of information. Remind yourself at times to book winners. If you get your price target, don't say, okay, the thing is run $10 or whatever. Let's say it was like Shake Shack. It ran $10 from my entry. And I'm going to say, okay, it's going to run another 10. Don't be a pig. Take money out of the market when you can, when you have big profits on positions. If something's up 9 days in a row or something, don't say, okay, I think it'd go a little bit more for the 10th. Don't be an idiot. Put a trailing stop in. I always suggest that I think is a very useful piece of information. All right, so I think I covered a lot of my rules here. I think I covered a lot of them well. Let me answer a couple more of these stock-specific questions, and then we're going to call it a day because I have to get out of here. Crude oil, I mentioned yesterday that there was an outside day. It went higher on crappy numbers. Outside days don't necessarily only have to be to the downside. They can be bullish. And today, you basically closed at the high in oil, up significantly from yesterday. This should be no surprise. Today, you actually got a little bit of bear data out with the Baker Hughes rig count being up pretty big, and oil still was in beast mode higher. I would say roughly you have now a kind of I don't want to say a look below and fail because we did spend 2 days down, or really better part of 3 days, but I would say a look below, kind of want to say a look below and fail below the 200 MA. We're now basically into some resistance, into the 44s and 45s. The key for oil to hold is 42.50. Really 42.49, but I want to keep it simple. If it can hold there, I think that the next $10 in oil will be higher. If it goes lower, we could be kissing the canvas into 38s and 35s. So that's it. I'm going to keep it real simple, stupid with oil. So the VIX. People don't really seem to understand how to play the VIX. I don't like playing the VIX directly. I've never consistently been able to make money buying VIX calls or puts. If anything, I usually pay for the privilege to show myself that I can't make money doing it. What I can make money doing, though, is using that VIX as a gauge of when to be a premium buyer or seller in options, particularly that in S&P. The VIX is obviously super-duper low. I think everyone has been loading up and buying SPY puts just because they're cheap, but just because something is cheap doesn't mean it's going to come back into fashion immediately. We all know there will be a downtrend, I mean, not necessarily a downtrend, a decline in the market at some point, but if you're out there, buying weekly puts and, putting on, assuming it's going to be that day or that week, not really what I like. What I do think would be nice here is if you are very long, is going out a little further and saying into, like, let's say September or October or November or whatever, and buying some of those puts as protection against longs. That I have no problem with. And then if the market comes down, you could make it a spread maybe and sell some further out of the money puts or whatever. And if it just starts rallying, you could always sell some to cap it off, or even put a stop loss. Nothing wrong with that. We have some important Fed action coming up. Yellen is doing the speech, the Jackson Hole speech on August 25th, I think 25th or 26th. They said it on TV. I wrote it down. I need to take a look on my my Bloomberg calendar. How will the market react to Yellen? The answer is the same as my answer to what would happen if they raise interest rates. It depends where the market is trading at the time. If we've rallied very hard into Yellen, I would say it's probably going to be a sell the news event. If people are panicked and afraid and we're down multiple days, it's probably going to be a rally. It's going to be a Costanza moment, I think, to do the opposite. I would not be selling SPY premium here. I would be more of a buyer directionally. Obviously, I think that if there was a big break in the market, you would see that jump pretty quickly, and you'd have the opportunity to jump on that. I think, considering it's at a low basis, like for example, if the market gapped down, 2 or 20 or 30 handles, you probably would have some room to buy, because if it's only, let's say, at like a 15 VIX, you probably could play it for like a move to the 17s. If the market keeps rallying or stays choppy, I think the VIX could stay narrowly and choppy in a range, and I think that you might not be so thrilled with that position. So I'm kind of waiting for a break of the range to make my my determination on that. I don't always look, like I said, to buy the dead low. I like to catch the kind of the meat of the move, and I kind of chop off the bottom or the top 15%. I like to make that big chunk in between. So if I'm not first on a move, although often I am, just because of positioning and so on and so forth, I'm good at spotting those levels. But if something takes off a little bit in the beginning, I'm able to recognize that usually fairly quickly. If not, if it sometimes gets away from me, it does. Like I said, I don't have to be involved in every move. Let's just go right through some of these now. BABA. I've said in videos that I think BABA at some point, I've been saying this for a while, would get back to 100. We're pretty close. 98.45 is an important gap fill. I think we got 98.35, almost. We're within 10 cents. My guess is there'll be some sellers between there and 100. Honestly, I didn't even have a chance to look at I've been away most of the week. I didn't even have a chance to look at their report, but it was a gap and hold yesterday. The stock looks strong to me. I think it's going to go a bit higher. It may chop for a while and then want to retest the old highs, believe it or not, up at 120. But I think short term it's really run a lot. Keep in mind when I talk about trade location, were you the smart money buying BABA at 57 and 65? Yes. Are you the smart money now buying it at 98? Not so certain. Stock has moved a lot. It did a lot of penance and time in the low to mid 80s and even into the 70s. A lot of those people are chopped up, or they're long, or whatever. And I'm thinking that they're going to be looking to book some profits in a little bit. So I'd probably be at this point looking to start booking a little bit of the profits into BABA and start trailing up stops. I would be concerned if you start giving back more than 95. Let's say that's even a lot, believe it or not. I wouldn't want to give, for sure. You want to hold 95s. And even more than half of today's gains, I don't think I'd be so thrilled if the stock pulled back more than that. So the 95s are an important level in my view now, just so you know. Baidu is still, whenever I think of BABA, I always think about Baidu. Baidu is just in a... It was down on earnings. It came back. Still in a downtrend. I would wait to see if this can break the 200 MA. If it could snap the 200, I think it's going to have it could have some legs. If it is held back by the 200, it's probably going to just remain a little bit beleaguered. One of the things that I'm finding a little disturbing in the market is Disney and McDonald's. These are kind of were like the powerhouse stocks. Both of these are trading pretty crappy. Not to mince words. Disney is still on a downtrend. I think it could maybe rally to the 200 MA, but it really would need to get over it and hold it, in my view. It could be trying to set up for this W pattern. 99s, 100 is basically would confirm that. The problem is the 200 MA is roughly around there in the 101. So in my view, it needs to really, like, if it were to have like a gap, I don't see that happening because we're past earnings here. I'll keep it. Someone had asked me the other day on the stream, what do I think of Disney? And I said, because it was just getting up to like the downtrend, I said it has to still get over the downtrend and close over there and get over the 100 MA. If whoever, I don't remember exactly who it was at the time, but that was when it was in the 99s, and now it's in the 96s. So yeah, I'm a little concerned. That earnings day range, the low was 95.85, and the high of that day was 99.27. So I need to see that clear, that at the very least, the high of day of the earnings day over the 100 MA for the play to the 200. Anything below there, I'm not really interested, I have to tell you. You know what I always say, if a stock can't go higher on good earnings or can't go, or if it can't go down on bad earnings, I want to take the opposite side of that. If it can't go higher on good earnings, I want to be short. If it can't go down on bad earnings, I want to be long. Yeah, so that was McDonald's. Same kind of thing. I'll tell you this thing. I was just talking about this with someone I'm friendly with on Twitter. 200 MA was a lot of was resistance, support, and now should really have been support again. It's now kind of failed. This is looking almost like a big head and shoulders to me. And if this is to break, you could be looking at a stock that could fill the gap, close to 104 to 100. Believe it or not, as crazy as that sounds. It has a lot of moving average confluence above it now. It has the 20, the 50, and the 200. If it can clear the 200 and hold it, I'm fine with playing long for maybe the gap fill back to, I think for at least a test into the gap. I don't know if you'd get the full fill, but you might get 124s. If it can hold 120, what is this? 120, my chart is not giving me cooperating here. 120, you know what? I'm in too far of a time horizon. Let me go into a 9-month and zoom. This should do it. 120.58. So if you can clear there and you can get over the 50, I think you could see 124. Probably would look into the gap, so maybe 125s. But I don't love this pattern. I just don't. There's not a lot there for me. There's really not much of an edge. I think it looks really like a little bit of an iffy thing. Someone asked me about this stock Flow. I don't really follow Flowers Foods. It's been down a lot. I don't think I would be first shorting it here because it got into the 19s and now is in the 14s, and it's sold off ahead of the earnings. Again, not a stock I follow. I don't really know too much about it. I don't want to say it's okay to buy or okay to short because I really don't know. But I'll tell you this, I do know this. If you're long, you could use today's pullback low of day as a stop or a hard stop below 14.35. You could also, I guess, play long against that, but I don't know anything about this stock. I don't want to cuff it. Again, I stick to what I know. Someone asked me about Under Armour. I don't really follow this all that often. Still in a downtrend, still below primary trend. A bit iffy. 200 MA. Has been some. Looks like it was a little bit of resistance today. What was the earnings gap range? Yeah. All right. So let's use the earnings gap day range or the earnings day range. Anything here now below 40.54, I wouldn't want to be involved with this stock long. I'd probably want to be more short. Anything over there, I guess you could kind of just hold, but you really need to see the pattern change. The pattern here has been, it's making some lower highs and now some slightly higher lows. So that's compressing. It's probably going to break violently one way or another. Just wait to see if it can make a lower low, then you want to be short, or if it can make a higher high over that range, then I would say you'd want to be long. Very kind of keep it simple with that. Target. Someone asked about Target. Not one I follow. Really messy, really sloppy, messy looking pattern. Tough one. It's like trying to break back into a range, it looks like to me. it made a higher low. So what I would do is this, is I would draw a trend line here. It's making some higher lows on this leg. Did they report yet? They didn't. They didn't. Wait, did they report? Anyone know if they reported or not? I'm looking at the chart. I see dividend earnings are on 8/17. No, so they haven't reported yet. I'd be a little leery if this keeps rallying into the print, because it looks like it filled the gap and it's chugging. It looks like it had been down. It now filled a gap and is just chopping. So if this rallies, I'd be looking to take profits, maybe even a right or right out short. If this is down, if this comes, I wouldn't want to be long this into the number. Honestly, there's nothing in this pattern here that is screaming an edge to me. Google, I still think that Google wants to get the channel high. It looks like it's just consolidating a little bit. It held the 10-day moving average today and roughly stopped a little bit above trend. If you want to be like Johnny on the spot with this stock, the gap high of day was 803.94. As long as it holds 80, and the low of day was 803.64. All right, I like it long against low of day, and maybe not if you're like maybe flat, or could try a right or right out short below the low of day. As long as it's contained in that earnings bar, though, it's okay. If it gets below that low, it gets a real iffy to me. Facebook, same analysis as it's been. I think this is just going to be really choppy for the next few weeks. Yeah, it kind of today broke a little bit below a trend, the trend, secondary trend. It closed like basically right on the back of it, but still over the 10-day MA. I just think this thing is going to be choppy. What Facebook tends to do is either it rallies or gets up on earnings, then pulls back, chops a little, has a freak out to trend, and then rallies again. I think that I'm just going to stay by that playbook. As long though as it's above 129.79, it's sort of okay. 116s to me would be kind of the downside max. I'd be getting a little bit more concerned if we got below there. Yeah, that's just my thinking. Let's keep it simple. I'm going to end on IBB. Someone asked about IBB. The range high here you can constitute from 86.81 to 289. Sorry, 286.81 to 289.71. It looks like it's been holding. Yesterday and the prior day, which was the pullback low, was the 288s. Roughly 288.01, 288.08. I'll use that double bottom as a stop. Anything below there, I think you want to be cautious with. You could, if you want to give it a little bit more room, maybe the 200 MA. This, again, I want to stress what I said about trade location. Remember when everyone thought the stock was gonna break down? It had moved from the top of the range to the low of the range. It didn't, because it had already moved so much. Now everyone was excited, and I talked about this in the weekend review video at the last couple of weeks, that everyone thinks it's a breakout, but it came up from the bottom of the range. It moved too far too fast. It's hard to hold a breakout. If anything, you ran some stops and so on and so forth and squeezed some shorts. Now I think it's acting very healthily. It just needs to kind of consolidate and hold that between the 200 MA and the breakout range. If it can hold there and chop for a little bit, then I think it can extend. If it starts getting below there, it probably can pull back then mid-range, maybe the next $10 or so, 10 or 15 bucks, then would be down. Keep it really simple with that level. I will be more detailed with IBB in the weekend review video. Nothing if not but a tease, and it'll get you guys in and girls in to watch on Sunday. Anyway, that's my story. I'm sticking to it. I hope this video was informative. Again, I was away this week, so I wanted to go over some of the big themes. I find when I'm away, I often can think a little bit more existentially when I'm not like focused, lasered on a 5 and 15-minute chart. Anyway, I hope everyone has a great weekend, and I will see you in my weekend review video Sunday. Cheers.